Welcome back to your Sprott Money News, SprottMoney.com monthly wrap up. We're ready to wrap up the month of June 2023, which means the year's already half over, for crying out loud. So we're going to talk about June. We're going to talk about the first half of the year. We're going to talk about the second half of the year in this monthly wrap up. I'm your host, Craig Hemke, and joining us is an old friend and a favorite for this podcast. That's Bob Thompson. Bob is a longtime friend of Eric Sprott. He is a senior portfolio manager at Raymond James in Vancouver, right across the street from a whole bunch of different mining companies up there. Kind of has a heartbeat or a finger on the pulse of the heartbeat of the mining industry. It's always good to hear what Bob has to say. So, Bob, thank you so much for your time.
Hey, Craig, it's great to be on again. We got a sunny day in Vancouver, so I think I'll go golfing or bike riding right after.
Yeah. Let's do this fast. You can get out of there. Hey, and again, just a standard disclaimer, if you will, before we get started. Look, this content is provided by Sprott Money, and you can find their website, SprottMoney.com. You can call them at 888-861-0775 and tell them how much you appreciate this stuff. They post it for you free of charge. So visit them, use their services to buy metal or store metal. Or at least if anything, give them a like or a subscribe on whatever channel that you're watching this. That'll help them widen their net and get this important information out. Bob, let's just dive right in, my friend. On my site, I was just begging for a Fed rate hike back at the last FOMC because I wanted to get this over with. I didn't want another 6 weeks of hanging on every data point, and now rate hike expectations are going up. Oh no, now they're going down. Oh God, it's driving me bananas. But imagine it's driving you bananas too. What at least is your personal forecast as we go into the back half of 2023 from a macro standpoint?
Yeah, you know what I think is really funny is the Fed's coming in to save the world now from inflation, but they're the ones that caused it, and everybody tends to forget. But anyway, I guess they're going to save the world for us, so that's okay. But I think the most important thing is here, it's not what the Fed says, it's what they do, right? And Powell said recently at a Senate hearing, right? It wasn't a public forum. He was just talking to banking committee or whatever he was doing, and he actually laid it out, the secret, right there. And this is all you need to know. He actually said to them, he said, because he was explaining to the senators about how it works, right? And he said, what's most important, he said, is that we squash expectations. And he said, so people can't believe that inflation is going to be over 2%, because if they do, they're going to go spend and it's going to be self-fulfilling. So he said, we have to make sure that people expect inflation is going to go back to those levels. And he said, that's the only chance that we have of getting them back there. So all this job owning that they're doing, right? We're going to keep raising rates. We're going to keep raising rates. Well, the reason that they're doing it is so expectations of inflation come down, right? It doesn't matter whether they actually do it or not. They just want people to think that that's going to be the case. The other reason that they're kind of, doing this is the economic numbers that they look at are still okay. Right. I mean, if we were in deep recession and the market was down 40% right now, they wouldn't be doing it. Right. They couldn't do it. But that brings up the next thing here is it takes a long time, 16 months, for the economy to start showing effects of the interest rate increases. So I expect that in the near future. And we expect, some sort of recession. It depends how fast they come in and start printing money again. But this is interesting because what happened in the early 70s, and I think, my history doesn't repeat itself, but it rhymes. A lot of things are going on the same way, from the nifty 50 stocks of the late 60s to all the tech stocks right now. A lot of things, the dollar, the budget, everything. So what we got in the early 70s is a double dip recession, right? And those are killers because you get this recession, the Fed comes in, they print money, they reduce interest rates, they do whatever, but that causes inflation. Right. So then they got to back off the inflation. So they got to raise rates, which causes another recession. Yeah. So you get this double dip. And I wouldn't be surprised to see something like that happen. Now, coming off those bases, that works really well for metals and minerals and value investing versus growth investing and all that. So I think we're, a lot of people maybe don't want to admit it, but we're in for, a 70s type of decade here. And, that's a great thing for metals and minerals.
Yeah, that's exactly right. That was the late 70s and the stagflation and nominal interest rates that were 10% and higher. It was a
Right.
pretty good time for the precious metals. Bob, you wonder, I've wondered along, what will it take to get the metals to finally really break out? And it probably will be a recognized movement, a shift by the Fed. We've had a couple of fake outs so far this year. Had a big month of January that got everybody excited, and then the data got better, and down we went in February and into March, and then we had a big April and into May, and then the data got better. I wonder if you're seeing any signs to suggest that the metals are getting ready to break out. Are we near a low again?
Right. In the metal space, really, it's all about sentiment in many respects, right? Pierre Lassonde said recently, and Eric said this too in the past, but in a different way. But Pierre Lassonde said recently, he said, I don't know why everybody thinks this is so hard. He said, the precious metals space is the easiest place in the world to make a lot of money, right? And right now, everybody's thinking, what's he talking about, right? And the reason he said that is because he said there's no other sector that sentiment gets so low and sentiment gets so overblown, right? So he says when sentiment gets terrible and everybody hates it, he said that doesn't happen with banking stocks or different areas of the market. He said just that's when you go in. That's when you got to go in. That's when there's value. And he said on the upside, it gets ridiculous on the upside. So you got lots of time to sell off. And I thought that was fantastic. And as you know, I've repeated what Eric said 1,000 times in this show. Eric said he loves the mining sector because the lows are so low, the highs are so high. The difference between the two is 1,000%, and there's no other sector in the world that happens, right? So Eric's saying the same thing, but you just got to go in when the sentiment is terrible, and the sentiment is terrible right now. And there's lots of ways to determine that, right? One is, a lot of people say they don't pay attention to the gold to silver ratio. Sure, it doesn't matter on paper, but right now it's 85, and anytime it gets over 80, it means the sentiment is very bad for the sector, right? I mean, it hit 100 in March of 2020, right? But other than that, it never really gets above 85, 90. If it does, that's a great buying opportunity. So we're there on that one. The other kind of big one that I think is really important from a big picture perspective is the HUI, which is the gold bugs index, to the price of gold, right? And that ratio, you can go back many, many, many years, but let's just go back the last 10, 15 years. It's only been above 9 once or twice. So again, that's gold divided by HUI. So it's only been above 9 a couple times, right? It hit, right now it's about 8.5. So we're getting into that buy range, which tells you the stocks are really undervalued compared to the price of gold, because really the price of gold isn't too bad. It's up 5% on the year, right? I mean, that's pretty good. Other than 7 stocks on the NASDAQ, that's one of the best performing assets this year, but the stocks aren't there. So that tells you there's a good value proposition. It was at 9 at the end of 2018, right? And we know what happened in 2019. A few months later, and it reached 10. 10 was the highest that it's been, and it reached that at the end of 2015, right at that puking point, the final puking point for gold. And interestingly enough, it went to 5 in about September of 2016.
Right.
So that's what I'm looking for. This 8.59 for the Huey. Again, it doesn't mean anything other than telling you that the sentiment is really, really, really terrible. And when sentiment's bad, great time to look at it, generally speaking.
And I think this came up in one of the other Sprott Money podcasts this month. I remember back on March the 7th, Bob Powell was doing one of those Capitol Hill deals. And he was talking about, oh yeah, we're going to keep rates higher for longer and all this. I mean, he's the head of the Fed, right? So he should be aware of what's going on. It was 3 days later that the Silicon Valley Bank thing began to blow up. And so, this can all change on a dime. And if Powell himself doesn't know what's out there, then how do we know we're not going to walk in on Monday and you'll have missed the low? So that's something you got to manage too, right?
I can't believe that, they really can't see things coming and get things so wrong. But I will, in one defense, I'll say one defense here. I thought of this the other day. I was leaving an event, and I think this is a great analogy. I was leaving an event and I was going to take the freeway, and my iPhone said, don't take the freeway because there's too much traffic. So it gave me an alternative route. I got on the alternative route, And within 10 minutes, I was in this horrific traffic jam for 45 minutes. And I looked and there was an accident 6 blocks ahead of me on this route. So then I had to change and I had to go back to the freeway because by that time the freeway was in better shape. So what I'm saying here is this whole economic outlook is a huge multivariable equation, and it's dependent upon so many other things, right? So it wasn't that my iPhone was dumb. It was just responding to what it was telling me, but it didn't know what was going to happen, 5 minutes into the future, that there was going to be another accident there, right? And I think that's a great analogy for the economy because, things are all going along fine. Risk happens slowly and then it happens all at once.
Yeah.
Right. As they say. So, Powell was talking the way he was talking. Then we had an accident ahead of us. That was the Silicon Valley. Then you got to go a different route. Right. So interesting that, they have trouble forecasting this, but, sometimes things do change too.
Yeah.
So I think they've been surprised and everybody's been surprised here that we haven't had more breaks. But I think they raised interest rates so fast that there was lots of momentum and it hasn't had time to respond to that. But when it does, it'll be like hitting a brick wall.
Yeah. Bob, I want to discuss something a little kind of semi off topic, I guess, of directly impacting the precious metals, but I think it's something that is of interest to most of us that are in the precious metals. You had written to me and mentioned something to me that called Parkinson's law. Mm-hmm. And I thought, well, that sounds interesting. Why don't we discuss that for a minute? Because I think that's something people might find of interest.
Yeah, especially your listeners. I think Parkinson's law, and I won't go into it in detail. People can Google it. But what's important to know about Parkinson's law is I think that tends to explain a lot of what we're seeing from a macro perspective, because people are scratching their heads going, how are these job numbers good? And,
right.
and how are things continuing on the way they're continuing on without this bottom falling out yet? Well, interesting enough, Parkinson's law basically, as far as government concerned, is the reason why governments continuously expand and continuously get bigger and never really get smaller. Because with Parkinson's law, basically, you have to hire somebody. If let's say you regulate something, right? Well, now you have to hire more people to regulate the increased regulations. Well, once you do that, they create more regulations. So then you have to hire more people to regulate the regulation of the new regulations, and you see how it ever expands like that. And just to show you kind of a couple examples of that, the Fed has 400 PhDs on staff, 400. And a salary budget of almost $3 billion, a budget of almost $3 billion, 400 PhDs. And the reason I've said that so many times is because once you hire somebody, they have to have somebody to support them now. And then they have to have somebody as a research associate. And then they have to have somebody. So it just gets bigger and bigger and bigger and bigger. Stanley Druckenmiller said recently, who's one of the best money managers in the world, he said, the reason I've been able to outforecast the Fed as far as every recession that's happened in the last 40 years is because I look at market variables and I look at things and how the market's reacting and credit and all that. And he says, the Fed doesn't look at that. Well, interestingly enough, so one guy sitting on his computer screen has forecasted the recessions better than 400 PhDs at the Fed.
Yeah. And
the same thing can be said for Eric. Eric saw all of this coming up into 2008 and the articles he was writing in 2005, 2006, one guy sitting at his desk saw this happening, saw the banking crisis, saw this, and the Fed didn't, right? So that's Parkinson's law. And here in Canada, interestingly enough, these are shocking numbers. 22% of all employment in Canada is government. That's about double the US. Now the US is bad. Canada's double. Canada, that's about the same as Venezuela. Okay. And here in Canada, 86% of the job growth, 86% of the job growth from COVID, the start of COVID until now, has been government. Jeez. So you wonder why we're in these, supposedly the economy is great and we're running $1 trillion deficits, right? You wonder why here in Canada, 10% of our total budget is spent on interest, right? And that never gets better. And it's due to Parkinson's law. It's quite interesting.
It's not sustainable.
No, it really isn't. It really isn't.
That's remarkable. And I thought it was bad here in the U.S. to think that it's twice as bad north of the border. My goodness gracious.
Yeah.
Well, all right, Bob, as we wrap up, I thought it'd be kind of fun to pick your brain a little bit. I mentioned earlier, where you're situated in Vancouver. You hear a lot of things. You focus on the mining sector, obviously. I know Eric is very excited about Newfoundland. I think he's made that quite clear. And the prospects, all this undiscovered territory up there that they're going out and wow, this is really something. Just in general, I mean, are there some ideas within the mining sector, areas you're keeping an eye on?
And like you said, here in Vancouver, from my office here, within 3 blocks, I've got about 80 junior mining companies, their head offices. So I can head over to any of them and be over there in 2 minutes. So yeah, it's nice to have the to kind of feet on the ground in the area that's important here. But yes, I was talking to Eric 3 days ago, actually, and we were talking about Newfoundland again, right? Because that's Eric's primary focus right now, is what's going on in Newfoundland, and you wonder why, right? Why is that Eric's primary focus? Well, let's go back in time 110 years ago to the first discovery in the Abitibi region, right? 1906 or 1909, you can debate, but that was the first discovery in that area, and it turned out to be this massive gold belt, hundreds of kilometers long. Kirkland Lake is right at the center of that, and in the last 110 years of production, there's been 200 million ounces of gold come out of there. 200 million ounces, not of silver, of gold. Absolutely incredible. So what Eric thinks, and we have an analyst here at Raymond James who's done a report comparing the two areas, is that Newfoundland, the central gold belt there, could be another Abitibi, right? Wow. Same distance, same length. And they really haven't started discovering. They've only started looking at things in the last 10 years. And that's what Eric sees, is that we've got a good jurisdiction, right? Hopefully Newfoundland's not going to steal the mines away from people, right? It's a good jurisdiction. It's an easy place to do business. It's an easy place to get permitting. They're pro-business, they're pro-mining. And we could have decades here of new discoveries and gold coming out of the ground. So each individual company, that's fine. There's a couple primary companies which have made some of the big discoveries right now, but there could be just a huge area play here, and that's what Eric's really interested in. And if it's another Abitibi, this could be producing gold for 50 years, 100 years. And I know Eric says, long after he's gone, hopefully these stocks will be producing gold.
Maybe the Canadian government can generate some revenue off of it and pay for all those employees they're hiring.
Pay for all the government employees. We need more government employees. That's right.
Maybe that's the plan, Bob.
That's right.
Oh, good heavens. Well, my friend, it's always so much fun to visit with you. I should ask you, actually, before we wrap up, where are we on the mining clock these days?
Yeah, I think we've moved back a little bit. We're probably around 7, and we're probably 6:37.
Like daylight savings time or whatever we have.
Exactly. The clock's moved back. Good point that you bring up there. That's right. But I do think that, these are times when the sentiment is bad. And I'll give you one more driving analogy. And that is, when you're on the freeway and it's stop and go, and the other lane is always going faster.
Right.
You're always like, okay. And then finally you say, okay, I'm going to make my decision. And you move to the other lane. And then what happens? The lane you moved out of starts moving faster, right? That's exactly what it is in the market, right? So right now we're in the slow lane. We're in the slow lane in the precious metals area. And people are thinking, should I get out? Maybe I should invest in some AI stocks. Maybe I should invest in something like that. Well, mathematically, when everybody moves over to that area, it's going to become the slow lane. It just has to, right? And then your lane frees up and it becomes the fast lane. So all I'm saying right now, sentiment's really bad. Stay in the slow lane. Stay here. It's going to become the fast lane pretty soon. And when it does, you want to be there. You got to be there.
Yeah. Sounds good, my friend.
Right.
Bob, again, you're at Raymond James in downtown Vancouver. As we wrap, I know in the past you've offered your email address for anybody who wants to reach out to you.
Sure. It's Thompson Investments at raymondjames.ca. And we've got something called the Gold Digger, which is coming out actually tomorrow, which talks about the sector and some of these things we'll be mentioning here. And it's for mining executives.
Awesome. Thanks for that, Bob. And thank you for coming on this segment We try to do this a couple times a year. It's always good to hear your perspective, and I look forward to doing it again.
Thanks again, Craig. Till next time.
It's always fun, Bob. And from all of us here at Sprott Money News, sprottmoney.com. Thanks for watching. We'll have more content for you in July.